There we go. All right, we're on the air. Not on Instagram yet, but come on, Instagram, you can do it.
Yep, we're live.
We are okay. Good morning, everyone, and welcome to Sand to Soul. I'm your host, Stuart Fournier, and I'm a 25-year veteran of the real estate world here in the Los Angeles area and South Bay specifically. And it's my pleasure to introduce my co host.
Hello, everyone. It's Anastasia Bonholzer. I am a mortgage broker with AMS Mortgage Services, and I'm also in the South Bay, but I lend in all of the state of California, Florida, and Texas. And today was my idea of a topic. I told Stuart that one of the things, probably one of the reasons why I got into real estate is candidly because of a very stupid quote I read on Instagram maybe about 15 years ago that said, that 90% of all millionaires are made through real estate. And I really wanted to, at that time, 15 years ago, I was not in real estate, and I wanted to dive into that topic. I was wondering what the hell did it mean when people say that they're made through real estate, and that's where we end up today. That's literally why we're here today.
And it's funny because interesting note, years ago, I don't see them on the air as much, but years ago, late night TV just had an abundance of people teaching courses on this particular subject. And they're kind of all gone now. It's kind of interesting. And
Yeah,
I
like the
started,
late night infomercials.
yeah, they were like, I mean, there was
Yeah,
Tommy Vu, there was all these guys that were on
yeah.
TV, and I don't see them anymore. And I think it's very interesting because what it really means is something that we've known all along. It is a foundational thing for you to do in your investment portfolio over your lifetime. And I'll emphasize what we mean by that in a few minutes. But it is something that you should be doing. The problem is it does take some sacrifice and education on your behalf. And certainly, Anastasia and I can't teach you that in 15 minutes. We're not going to do that. So, we're going to give you a very brief overview of what that statement that she referred to means. And basically, what it means, without getting too complicated, is that yes, you do want to pay attention to an industry that does nothing but increase in value over the long term. And so let's start off with that as an example. I'm going to put something on the screen which, for example, shows what's actually happened in the beach cities since 2008. Now, if you look at that chart, what you'll see is it starts out at 2008, makes a huge dip, right, which was the most catastrophic period in time for real estate in over 50 or 60 years, maybe even longer. And so, even with that, with the most catastrophic situation that we've experienced in our lifetime, as you can see, 2005, which is at the top of that graph, shows that incredible increase. Yes, there's a slight dip right there up until about 2010. And truthfully, in the South Bay, we actually saw values stop going down in 2010 and then slowly but surely sort of bounce around and then go back up almost crazy. I mean, none of us would have predicted in 2005 that there'd be this kind of an increase. So it speaks to exactly why you should be involved in real estate, why you should invest. Now, that millionaire that you spoke about, I don't know what his story was, but I'm sure to some degree, there had to be some planning on his part, some understanding of how the market works. And let's face it, not all of us have that kind of time, that kind of effort. So I think what Anastasia also wanted to refer to today is what can the everyday person do, the person that can't necessarily spend 4 or 5 hours researching real estate opportunities and following up on them, because therein actually lies the distinction. If you are a true real estate investor and this is what you do for a living, that's a whole different discussion. It's a whole different way of understanding the market. But for today's purposes, what we wanted to do is just sort of emphasize the opportunities that you have as someone who maybe has a 9 to 5 job, but wants to in some way take whatever money they can save or whatever money they can put aside and invest it in real estate. So I'm going to start off a little bit by telling you some bad news, actually. And the bad news is that doing it in the South Bay is a pretty difficult situation. We have some of the highest values, property values in the entire nation. So getting your foot in the South Bay is going to be very difficult because, for example, on most of these TV programs, what they're doing is they're selling you what's called income property, wherein you're actually making money. That is to say, you have positive cash flow. That's almost unheard of in the South Bay when you make an initial investment of, say, 10 to 20%. In fact, you're actually, in most cases in the South Bay, going to experience the opposite. You're going to experience a negative return, which is acceptable to some people because they can actually write it off on their taxes. And I think, Anastasia, you can speak to that a little bit.
Yeah, no, it's true. I don't want to probably dive too deep into the tax return objectives, but if you're self-employed, there's definitely a lot of opportunities available for different deductions and losses as it pertains to somebody's income property or an owner-occupied property, from, deducting their home office to the interest off of the loan. In 2026, there are changes to the tax laws as it pertains to mortgage insurance. So now a portion of the mortgage insurance off of the loan can also be a deduction off of the taxes, but I always say consult with your CPA on the most current tax laws available at the time of the tax filing.
Right. So that's the bad news. The good news is that property value, that is to say, land value, is a guarantee. It's always going up. Yes, we have our bumps and bruises and our periods in which it doesn't go up. Like, for example, we're pretty much stagnating right now on land value. Okay, but the bottom line is that when I showed you that graph, it really refers specifically to how land value increases the value of your home, and so everybody is on that same trajectory. Excuse me. So
Yeah.
even though you have a property that may not be giving you what's called positive cash flow, which is again what these late night TV people are always selling, you do have a piece of property that over your lifetime, over 10, 20, 30 years, is going to be very important for your retirement. It may be
Yeah.
something that when you're 60, 70, or 80, you're going to sell, and it'll
Yeah.
sustain you for the rest of your life. So
It's a
it
good.
is. I'm sorry, go ahead.
And Stuart, I want to piggyback a little bit off of the math portion of it. When somebody comes to me and says, "Hey, Anastasia, I have $100,000. Why would I invest in real estate versus just putting it in the stock market, which also has the same rate of return?" Let's say, hypothetically speaking, and we've had very large increases of property values over the last, since COVID, let's say on average 6% a year. And probably less so in the luxury market, but for an average everyday consumer, if you buy $1 million single family home, it's plausible for that to increase on average 6%. So if somebody has $1 million, I'm sorry, $100,000, and they're saying, well, why would I invest that $100,000 I have into real estate as opposed to something like, the Fortune 500 stock market? And I say, okay, if you take $100,000 and you have a rate of return of 8%, you're going to get $8,000 a year, just based on your actual investment of $100,000. If you're applying that $100,000 and you're now buying a property at 10% down payment with your $100,000, and that property is now going to grow for somebody 6% a year, that is now $60,000. So which one would you like? Is it $60,000 per year, or is it $8,000 per year? And that's the difference between real estate and putting that same investment of $100,000. The value of the property grows. So the loan grows, the value of the property grows, plus the initial investment, not just the initial investment. And that's the true difference between stocks, bonds, mutual funds, whatever it is, other types of investments. And I always say a combination of all of them. Somebody shouldn't put all their eggs into real estate basket, although many people do. A good opportunity to set up a Roth IRA, in addition to investments, just traditional investments with a Robinhood account, plus then a combination of investment accounts, which could also be out of state, because many times, like you mentioned, maybe South Bay is not the ideal marketplace to cash flow immediately, especially for somebody who doesn't have a lot of extra cash to be able to carry that home month over month and not be at a net zero, meaning the mortgage matches the rents collected, right? Or maybe you would even want to exceed that number. And so then they can buy out of state, like Texas, Florida, other states, look to see where your family is located. And I've had many times, people buy out of state as well, and you don't have to self-manage. So maybe you can tell me a little bit about what would it take for somebody to buy a property where not in the South Bay,
Right.
maybe in other parts of California or out of state.
Right. Well, let me answer a couple of your questions. First of all, it's a matter of risk, right? In other words, if you're invested in the stock market, chances are you're spending a great deal of energy following the stock market, which is obviously incredibly volatile at all times relative to real estate, right? When you put your money into real estate, you basically check it out every 2 or 3 months, right, to see if there's an increase or a decrease or whatever. Your statistics basically comparing 6% to say 8 or 9% even is true. But again, it's your level of comfort, it's your level of risk, and more importantly, as far as I'm concerned, the amount of time that you want to put into it, right? So if you're investing in real estate, your mindset is much different in that number one, you have two options. Number one, you are constantly looking for another opportunity wherein you're probably putting improvements on that property and then looking to turn around and sell it, right? That's a different mindset. That's a different set of priorities for you to go about. Those are terrific ways to make money, even better than the stock market as far as I'm concerned, because what you'll see is the amount of energy that you pay attention to in that regard will pay off if you're turning property all the time. Now, that's kind of what these TV ads promote. Now, the second answer to your question is yeah, they promote this, but not necessarily in the South Bay. They're saying go out of state and do it. Go find your $300,000, $400,000 house, then do the same thing, right? So, stock market versus property, there's been tons of arguments to show how property in the long run does outpace the market, right? But it's such a, again, my thing is that you have to decide personally if you have the amount of time that it takes to be both involved in real estate and involved in the stock market, because they're just two different mediums, right? Some people can do it. I
Right.
can't do it. I didn't get involved in the stock market until later on in life. And, it's been very fun and it's been very educational. But the truth of the matter is that there's only a degree to which I feel comfortable actually putting my hands into it, making my own trades, understanding that kind of thing. I don't understand it. I leave that up to a financial advisor to make sure that they're, keeping on top of the market by being conservative. Because for all intents and purposes, most financial advisors are keeping ahead and contributing to the value of your stocks by being conservative, right? Now, there's again a whole thing where you can put yourself in very risky situations. I won't get into that, but you have more of a solid footing in real estate because, again, as I said, the volatility is not there. It's months and at the least weeks and weeks and weeks when you make an improvement and you turn around and sell. So again, there are two different things. Personally, I believe that you should put most of your money in real estate, and the money that you
Yeah.
feel less comfortable about, money that you, let's say, we call it a little more risky, you put in the stock market, and it's a good balance. Bottom line, though, is that you
Right.
do foundationally need to invest in real estate because real estate will take care of you in the long run.
Yeah, I want to piggyback. Another thing is, I listened to Dave Ramsey this morning, and there was a woman that called in and said, I'm 48 years old. I have the ability right now to buy a home in cash, or should I continue renting? And my rental payment will match. So she doesn't want a mortgage, and she wants to either buy a property in cash or continue to rent. Her rent payment will match the taxes and insurance on the property and the HOAs, whatever property she wanted to buy. And she was asking Dave for his advice whether or not she should buy real estate in cash or she should continue rent and be more loosey goosey with her life. Even he said, buy real estate, even though I know he's a very conservative person when it comes to acquiring debt. He said, what happens with rent is it will continue to increase for you. So you think, okay, right now it's going to match, but the chances of your property taxes and homeowners insurance increasing at the rate that the rental will increase for you is there's a big difference.
Right.
Property taxes, yes, they on occasion increase, but not with the same severity and the same slope as rents. Because rents can increase, and most of the time they can increase up to 10% a year, depending on how your landlord and how quick he wants you out of there. But 5% is not unheard of to be consistently be charged 5% more each year for the rent.
And the bottom line is that young people are very frustrated, deservedly so, because they just don't have the same mountains to climb that we did when we were younger. That's just the truth. But planning ahead, maybe possibly buying things out of state, which has its own risks. It has its own responsibilities. It has its own vulnerabilities in terms of keeping track of the property and who's looking over your investment. But you do, in some way, shape, or form, in terms of your future, have to stop renting because you are throwing money away.
Yeah.
When you look at your figures today, some people ask a very legitimate question. I don't really care. I can live comfortably right now. I can't afford a house, so I'm going to stick where I am. Well, that's understandable. It makes a lot of sense. You can't argue against the numbers at the time, but the bottom line is the numbers are going to change. Your ability to make that kind of income is going to change. You are going to get a little tired when you get older, and people are not going to hire you because you're older. There is age discrimination, If I had to go out and look for a job right now, I'd be scared to death at my age, right? Deservedly so.
Right.
So the only thing that's made me feel comfortable is that I, was lucky enough to invest in real estate at a fairly young age in my 30s. But as soon as you can do it, you need to do it because, again, it takes time and it's a nest egg. So, again, as I said, it's hard to argue with young people about the numbers as they stand today. But
Yeah, so they should just start at somewhere like a smaller property, and just not go all, buying smaller is my recommendation. If
Right.
somebody's not comfortable with the mortgage payment, scale down, buy an investment property first, which is exactly what I'm doing for one of my first time home buyers. She lives in Long Beach. She's unable to buy her own owner occupied property because the properties are too expensive. She's buying an investment property. And it's as simple as that. She's buying a
Good for
property
her.
for $325,000, a condo, just as a starting point to her real estate journey. And she's a first-time home buyer, but buying her investment property first. And we're closing this week on that property. So I'm very excited to share that these opportunities do exist in the South Bay. It doesn't have to be so, outlandish. There's still very reasonable prices that exist in parts of the South Bay. Maybe
Right.
not Manhattan Beach or Hermosa, but definitely Long Beach, San Pedro, Harbor City, Lomita. I can go on. Harbor City.
Right. No, anywhere in the basin is fine if you can do it. The basin, LA basin, is going to be, of value for as long as we can imagine, honestly, and it's only going to improve.
Yeah.
But we've got 1 minute to get off the air, so let's close out on that positive. I'm so happy to hear about your client, and congratulations to them.
Thank you.
And
Yeah.
we'll see you next
Exciting
time,
times,
everyone.
for
We
sure.
do this 11 o'clock
All right. Until
every
next week.
Tuesday, and we invite you to ask questions. If you have a subject matter that you'd like us to cover, we'd be happy to do that. And tell all your friends and family. Let's talk real estate, 11 o'clock Tuesday morning. Bye, everybody.
Bye.